Hi, Tom Lydon here in Chicago at the Morningstar ETF Conference. Here with Mike Arone, Chief Investment Strategist at Sate Street Global Advisors. Great to see you, Mike.
Good to be here, Tom.
So we want to talk about fixed income. You know, if we had a gun to our head a year ago, most advisors would not think that the fixed income market would be where it is today.
It continues to be the biggest challenge for financial advisors is what to do with fixed income.
Yeah.
Everyone thought rates would be higher at this point in the economic cycle. We have 3 more Fed meetings for this year. We have budget negotiations, the debt ceiling conversation, which is now going to take place in December, and folks are unnerved. They're anxious about what to do within fixed income.
Yeah. So what are a couple of things that advisors need to think about?
At Spider ETFs, we're recommending 3 things for advisors. You got to be flexible with your fixed income. We're not sure if rates are going to go up or if they're going to go down.
Yeah.
So we talk about core, complement, and cushion. So core, for example, you want an active core fixed income manager with a yield that's higher than the benchmark, like the aggregate, and a duration profile that's better. So we think of folks like Jeffrey Gundlach at DoubleLine, for example, does a great job there. We want to complement existing credit positions in high yield and investment grade credit with things like bank loans. Get access to floating rate, move up the capital structure, shorten your duration. And lastly, we talk about floating rate investment grade corporate bonds. So again, move up in quality, shorten duration, and still capture some yield. Those things tend to do well when rates go up or down.
Yeah. So the average advisor that benchmarks to the Barclays AG, what you're saying is there are a couple moves that you can make where you can actually improve the risk profile and the yield at the same time.
Absolutely. What's happening in fixed income right now is most fixed income instruments have a yield that's very, very low because interest rates are very, very low.
Yeah.
Right now, as we're chatting, the 10-year is just hovering around 2%. And the interest rate risk that those financial advisors are accepting with something like the AG is much greater. It's kind of an awful trade-off.
Yeah.
So these things will all help you kind of change that risk-return trade-off to be much more favorable.
Sure. So ultimately, dissecting the AG and pulling out the Treasury component to subsidize it with these other alternative strategies and an active strategy makes a lot of sense.
Absolutely. What it helps you do is get more yield in a time that's really difficult to do that. It helps you shorten your duration, so in case your interest rate sensitivity risk goes up unexpectedly on interest rates, you want to make sure you're protected in your portfolio.
Yeah.
So each one of these things, the active core, the bank loan allocation, and investment grade floating rates help you to do those things.
Excellent. Mike, as always, great seeing you.
Good to see you, Tom.
Thank you.